Today, we will talk about accelerated depreciation, what it is, how to calculate it. Accelerated depreciation is any method of depreciation used for accounting or income tax purposes that allows for greater depreciation expenses in the early years of an asset's life. Examples of accelerated depreciation methods include the double declining balance method and the sum of the year's digits, SYD, method. These methods result in higher depreciation expenses in the first few years and lower expenses as the asset ages, unlike the straight-line depreciation method, which spreads the cost evenly over the life of an asset. The rationale behind an accelerated method of depreciation is that it appropriately matches how the underlying asset is used. As an asset ages, it is not used as heavily, and an accelerated depreciation method aligns the recognized rate of an asset's depreciation with its actual use. This means that accelerated depreciation tends to occur at the beginning of the asset's life when it is new, functional, and most efficient. Using an accelerated depreciation method has financial reporting implications. Because depreciation is accelerated, expenses are higher in earlier periods compared to later periods. For taxation purposes, these methods will result in a deferment of tax liabilities since income is lower in earlier periods. However, public companies tend to avoid accelerated depreciation methods, as net income is reduced in the short term. The double declining balance method is an example of an accelerated depreciation method. It involves taking the reciprocal of the useful life of the asset, doubling it, and then applying this rate to the depreciable base for the remainder of the asset's expected life. This method results in the dollar value decreasing over time because the rate is multiplied by a smaller depreciable base each period. The sum of the year's digits method is another example of accelerated depreciation. It involves combining all the digits of the expected life of the asset to determine the rate of depreciation for each year. This method allows for higher depreciation in the earlier years of an asset's life, which decreases over time. Here are 4 key takeaways. 1. Accelerated depreciation is any depreciation method that allows for the recognition of higher depreciation expenses during the earlier years. 2. The key accelerated depreciation methods include double declining balance and sum of the year's digits, SYD. 3. Accelerated depreciation is unlike the straight-line depreciation method, where the latter spreads the depreciation expenses evenly over the life of the asset. 4. Companies may use accelerated depreciation for tax purposes, as these methods result in a deferment of tax liabilities since income is lower in earlier periods. Hope this would help. Thanks for watching.